Hello, everyone. Welcome to today's webinar brought to you by ACG PERT. Uh, keeping costs down is a subject on everybody's mind, and we're lucky enough to have Alliance Cost Containment on today, where we'll discuss how to reduce costs at the portfolio level and at the PE firm level. Joining us today is Miles Lee, CEO and President of Alliance Cost Containment, as well as Emmy Wexler, Executive Partner with Alliance Cost Containment. We're going to go ahead and turn this over to Miles in just a minute, where he'll go through some things that I think you guys are going to find very interesting. And then we'll get into conversation and questions. We want to field as many questions from the audience as we can. So with that in mind, please feel free to use the Q&A function and chat in your questions, and we'll be sure to answer as many as we can. For those we do not get to, we will make every effort to answer at the end of, after the webinar. We'll go ahead and answer questions that we didn't get to. So please remember to use that chat, and I am going to turn it over to Miles to get us started. Thanks for being here today, Miles.
Thanks, Danielle, and good afternoon, everybody. I really appreciate the PERT group giving us, ACG PERT group giving us the opportunity to speak and present today. First, as Danielle mentioned, I'm joined by Emmy Wexler, who's heads up our private equity business development efforts and based in the New York City area. Kelly Gold's also Vice President of Business Development. She's based here in Louisville, Kentucky, which is where our home office is located, and which is where I'm located as well. So briefly about ACC. ACC, we help our clients, capture EBITDA improvement through the reduction of indirect procurement expenses. We typically work with clients, with $100 million in revenue and higher. Our largest client actually has over $100 billion in revenue, and on the smaller end, we'll go down to occasionally go down to 50, 60 million in revenue. But generally, as a starting point, most of our client base, representing a wide range of industries, is north of 100 million in revenue. And oftentimes, we're connected to these clients through strategic partnerships and relationships we form with mid-market private equity firms, which is going to kind of be the theme of the presentation today. So for today's webinar, I'm going to start off with a few remarks about indirect procurement expenses, highlight some common misconceptions and best practices, and also just to briefly discuss some of the COVID impacts that we're seeing on procurement and cost in general, particularly as it relates to the procurement function. And then, as Danielle mentioned, we'll have kind of answer any questions that are submitted from the participants, and those that we can't get today, we're happy to address offline after the presentation. So as it relates to private equity firms, ACC offers 3 services to PE firms and their portfolio companies. The first, kind of on the left of the screen as you look at it, is analytical support as part of a due diligence process when a PE firm is looking at making an acquisition. We'll go in and help the PE firm project the future cost savings potential during the pre-acquisition phase that would occur after the acquisition. Clearly, the benefit of that is that the PE firm can then use that in pricing the deal, and particularly when it's a competitive bidding in a competitive bidding environment. The second one is our core offering, which is implementing meaningful cost reduction and EBITDA improvement in up to 35 common expense categories, which we'll cover in a minute. And then the third is on the outbound side. When a company's kind of in the exit environment, we'll go in and really kind of audit the savings and project it forward so it can become part of the Q of E quality of earnings element of an exit transaction, as well, which is obviously used to justify increased enterprise valuation. So, obviously, to a private equity firm, every $1 million saved is worth 10, 11, 12 million dollars in enterprise value. So that's all our savings audit process enables PE firms to project a value using that equation. While we do offer these services as standalone, we often provide all 3 during the course of a typical client engagement. So this slide shows the 30 plus indirect expense categories that we manage. We usually never manage them all at once. We'll generally start with a subset of these with each client engagement and then expand as needed. Collectively, though, these areas, can amount to as much as 50% of all companies' expenses with third-party vendors. These areas typically require a lot of companies' our clients' internal procurement resources to effectively manage through lots of vendors, lots of line items, lots of service considerations. So in our model, we bring a team of experts and project managers and analysts to come in and really kind of become an extension of our client's procurement team to be able to package and manage these, not only driving prices down, which is the ultimate barometer of cost, but also improve processes, improve services, and improve measurement, which is the main reason why a lot of our engagements we end up having extended cycles of our engagement and often go through multiple terms with the same client. So, kind of some of the common misconceptions about indirect cost reduction. First, some assume that the overall savings potential is low or could be low, since these are non-core items. And, for instance, a manufacturer, definitely something like steel or raw materials is going to be a really high procurement cost. Well, they may not think that telecommunications or commercial insurance or some of these other areas are. Well, collectively, they actually are. And that's one of the more enlightening things that companies like ours bring to the table. But often that's our first common misconception that we see as well. It's really kind of low potential savings. So I'm not sure how exciting it gets. The second is maybe tied to the first a little bit. It's just kind of not worth the time or effort. Oftentimes companies will believe that going through an full indirect cost reduction effort, even if it's with the help of a third party, can consume a lot of clients' resources. And we try to structure our engagements so that we're actually reducing their time and effort on these areas, not increasing them. And then one that we occasionally also hear is that, our spend's already optimized, you can't help us. And while in some cases that's usually true in a category, in almost every engagement we'll find categories where we can't find savings. The flip side of that is oftentimes we'll find kind of pleasant surprises, savings in areas that clients didn't realize existed. And so anyway, our view is that there's always room for improvement given the sheer volume of recurring expenses and multitude of competitive supplier choices that are out there. And I'll briefly go through a couple of case studies, the next couple of slides that'll make that point. So this one is a recent client of ours, a $450 million manufacturing company that was owned by a $2 billion AUM mid-market private equity firm based in the New York City area. This particular client was a platform investment for the PE firm. They eventually had multiple add-ons while we were working with them. So the scope of the engagement grew. You can see some of the high impact areas such as MRO stands for maintenance, repair, and operational supplies, freight, packaging, and commercial insurance and telecommunications. So this company was extraordinarily effective at managing its raw material purchases. Had some of the best sourcing people in their industry focused on strategic spend. They would openly admit they didn't apply that same type of discipline and focus on indirect costs. So as a result, we were able to identify, just under $4 million in annual savings over a period of our engagement. And more importantly, after fees and costs associated with the engagement, the net enterprise value creation, according to them, was just under $40 million. So you can see some of these maybe more benign areas that aren't strategic, they can very quickly and collectively add up, not only in savings, but in the increased enterprise value. In this particular case, it took our team about 6 months to generate this result. And our fees are based on actual realized savings. So the risk reward ratio, which is not easy to say twice, for the client was quite favorable. So this next slide is another private equity client. It kind of shows the network effect once you get started working with a PE firm. Once the results are achieved with 1 or 2 companies inside a portfolio, the PE sponsors often take a more systematic approach and almost calendarize the cost reduction effort. So in this particular example, we worked with 3 companies initially, which led to the scheduled kind of onboarding of 1 new portfolio company per quarter and their add-ons. So in this example, we're in process with some of these, but to date, the enterprise value is total enterprise value created is estimated to be in the $70 to $80 million range across 8 companies. So for the portfolio company perspective, this type of cost reduction platform can help companies share best practices, share best vendors, leverage vendor pricing, enhance reporting, standardized practices all across the portfolio without having to add or distract the resources. So those are some case studies, kind of highlighting what we do in the value in the private equity space. Now let's shift to some of the best practices, specific portfolio companies. And these could be some of your all's clients if you're a consulting firm, a service firm, an accounting firm, or it could be, obviously, if you're a PE firm in the audience, it could be some of your portfolio companies. If you're a portfolio company in the audience, this could be you. But these are some ideas, whether you work with a third party or not, we would suggest companies consider. Some are probably pretty obvious to most of you. That's a bit of a disclaimer. Even so, they're very important to highlight if you want to implement a successful cost takeout initiative, either individually with a company or across a portfolio. So the first and most important best practice, fairly obviously, is making it a C-suite priority. Some of our most successful engagements are based on really strong C-suite commitment to continual savings and efficiency. Using kind of the analogy of personal fitness, the people who commit to daily or weekly exercise are going to generally be the healthiest, people and the most fit. Some companies view cost reduction as a once every year or two activity that has kind of a start and a stop point. Others even less frequently than that. Those are the type of companies that probably don't realize it and are understandably very busy, but those are the ones that we typically find are leaving the most company on the table. So kind of a commitment from the top that cost reduction is part of our corporate DNA is, in our view, whether you're working with somebody like us or not, obviously very, very important to achieving optimal cost reduction. Another best practice relates to kind of measurement of how you spend your dollars. And this can get tricky because of all the millions and tens of millions of dollars that are being spent with thousands of vendors. Most companies measure procurement spend by category, i.e. we spend $3 million a year on telecom. Well, we don't think that goes far enough, and we think it's imperative to actually audit the line items underneath each category, much like you would analyze your sales revenue by product line. It's really no different. You analyze your purchasing by spend line item. So as I mentioned, we generate monthly savings audits for our clients that are analyzed at the individual line item or SKU level. Our average monthly client audit typically contains over 100 pages of detail like this hard to read information. And as you will see, this type of attention to detail really will make a difference in the results. So this is a recent example from a large client of ours, actually a large publicly traded client of ours. In this engagement, we initially reviewed over $15 million in this company's annual expenses on telecommunication, wireless and wireline. As a part of an initial kind of competitive RFP, we were able to generate over $2 million in savings just through competitive rate negotiation. But even more important than that, once we started auditing their purchasing activity, we discovered that the client had been paying $55,000 a month, that's a month, for phone lines that were discontinued or no longer in service. And this dated back over a couple of years. So with that discovery, again, only discovered at the kind of the line item level forensically in the billing information, we were able to identify an additional $2 million in value that was subsequently credited to the client once we discovered it. So in this example illustrates it's simply kind of negotiating a low rate and viewing spend at a high level, the category level. That's not going to always be able to optimize your cost situation in a category. This is another quick example, which may not entirely please any bankers in the audience, if there are any. With a very, very large fast food operator, we found almost $250,000 in overcharges on erroneous bank fees, dating back 2 or 3 years on bank statements. After we kind of corrected that, helped the bank credit the client. There's needless to say, their CEO was not happy with their longtime banker, who was also a close friend. So another example of, again, we're not going to be able to change their interest rates or some of their base cost of banking, but we are able to correct and optimize where there were overcharges and recover those for the client. Another best practice is the importance of being open to new vendors. So we talk about C-level commitment. We talk about measuring spend at the line item level. It's also really important to be open to using new vendors. And we all fall in that comfort zone of working with our favorite incumbent vendors, which, longstanding favored vendor relationships are very comfortable. The staff and the resources know each other, and they fall into a pattern of kind of redundancy that gets comfortable. Most clients of ours have at least a handful of longstanding protected sacred cow vendors they, quite honestly, they don't want us to get involved with. Well, certainly there are merits to having those close ties with your vendors. In our view, these relationships can create a complacency that cause companies to miss out on significant savings and high value offerings from suppliers they're not considering. Briefly, in this example, a client it's a very large food service distributor. They had worked with the same insurance broker, a very, very successful and high quality broker for more than 10 years. We're very comfortable with the broker. A new CFO came on board and asked us to kind of test the market. And the result was, almost $1 million total reduction in premiums, as well as an improved risk registry or coverages. And the incumbent broker retained the business. So historically, this had been a 20-year long-standing relationship. The market just kind of crept upward, and there was no professional bad cop, if you will, to come in and try to hold everybody's feet to the fire. So in this particular case, being open to considering new vendors, which in this case the incumbent broker felt, generated increased value from the incumbent. So the final best practice I want to highlight today is the importance of effective supplier contract management. And the reason I want to bring this up is really this is something that does kind of rear its head during the COVID era when people are working remotely. A lot of companies, particularly large ones with multiple operations, multiple locations, lack the proper visibility of their contractual supplier contracts. As such, opportunities to capture savings or worst case costly surprises arise due to that lack of attention. And one very common example is the auto renew. You could have every intention in the world to renegotiate your facility's maintenance contract. However, if your existing contract auto renews 90 days in advance and you're not tracking that, then you're stuck. And oftentimes, unless the supplier is willing to kind of acquiesce a bit, you can get locked in a suboptimal high cost relationship. Additionally, in a lot of these categories, like almost any industry, there are new disruptive supplier choices out there that are constantly driving costs down. And by locking in a contract and not being able to explore those, you're really kind of missing out on some real cost reduction opportunities. So contract review is something that companies particularly should do and really focus on in the COVID environment. We actually recommend our clients or companies to kind of schedule a standing review of it and make sure there's very kind of high visibility documentation of when contracts expire and making sure you do all the proper notifications in advance. So, I'd like to spend the final portion of my time kind of highlighting the methodology typically used to achieve the type of cost savings. While some of these results can be achieved with internal resources, companies often choose to work with third parties like ACC and allocate their internal resources on direct or strategic spend items. So basically, in a nutshell, what we'll do is we'll come in and gather a lot of data on the front end, become oriented with an organization's objectives, their supplier objectives, and then we will ultimately introduce a competitive tension in the marketplace that generates the savings. So data, communication, understanding of needs, and really kind of seamlessly integrating with the staff is really kind of important if you're considering using a third party. But it goes to say that in the COVID environment, it's impacted all of our businesses and organizational functions in some way, shape, or form. From the perspective of corporate procurement, certain categories like freight, parcel shipping, and commercial insurance, the costs are actually going up. Obviously, packaging and parcel shipment, I mean, it's with the advent of everybody ordering from their home office or home, there's a lot of demand for corrugated boxes or overnight delivery. So that's really kind of been a cost increase driver for companies in recent months. The real strategy there is cost avoidance, not necessarily cost reduction. On the flip side, there's categories like travel, corporate travel, hotels, rental car, airfare, some of the facilities supplies where the costs are actually going down. And now's a great time to renegotiate if you're locked into a contract that maybe had more expensive terms than the market will bear today. But either way, we think it's imperative for CFOs and procurement teams to really kind of stay abreast of what COVID is doing to each of these areas. It does help your budgeting going forward. If you can anticipate that your certain costs are going to go up, and but also it identifies areas where you can maybe capitalize on savings where you didn't think it is achievable. And so kind of I guess this is the last slide before questions. One thing that we do and certainly would offer up to anybody on this participating in this webinar who is interested, or if a client of yours is interested, is we'll put together a savings roadmap, a confidential proprietary savings roadmap for your client or for you or for your PE portfolio company. Using a tried and true process, we'll be able to come in after looking at certain elements of data. We don't charge a fee for it. We don't ask for a commitment, and be able to tell you what we think in today's environment over the next 12 months, the true savings potential is, where we think that exists, and how we think we can achieve it. And at that point, you decide if you're interested in, taking it further or not. Otherwise, we don't believe in kind of conceptual sales. We believe in a working with a client based on an educated conversation over what the realistic potential is. And so we, over a period of, once we get the requisite information, which we can share offline, generally takes us about 2 weeks to put together a custom report for you. And then we have a follow-up call and we talk through, and then at that point you decide if you want to try to do it yourself or work with a third party. So I believe that is our, as we draw to a close, just in summary, obviously private equity firms, they view the value of every dollar with a multiple. Our model is structured to integrate in through the PE firm into the portfolio organization, kind of honoring their culture and environment. And this, as you can see in these slides and some of the other case studies, the results are meaningful, impactful, and proven. So told Danielle I keep it inside of 20 minutes. I think I'm slightly over, but turn it over to Danielle for questions.
You're perfect. So I just want to encourage anybody to submit questions into the Q&A panel, and we'll get to those. But before we get to those, I just have a few questions of my own that maybe we can talk about just for a few minutes before we move forward. So Miles, you touched on how firms would work with you, about collecting the data on the front end and doing some preliminary work. But can you talk about that like a little bit more specifically? Like, what does that engagement look like? What's a timeline? What's a process? Just give us a little bit more information on what that looks like, if you don't mind.
Yeah, sure. So that's a good question. Typically the timeline, we can start to discover the savings inside of 3 months, assuming the data is available. And then in some cases even start implementing it very quickly. If there are binding contracts or other reasons, or maybe some more complex areas, it might take a little longer. From the client standpoint, we try to make it as orderly as possible, where once we collect the data and understand and interview the stakeholders, we really kind of report up to them and do the work, and they are available for approvals and for advice, obviously, but we try to make it so it's as minimally invasive as possible from the client's perspective. Once the savings is implemented, then it's just a routine, monthly audit, making sure, and this is the most important part, making sure that the savings that's promised is actually delivered. There are a lot of good companies that do what we do out there. I think one of the major drawbacks is a lot of companies are really good at negotiating competitive pricing, but then when you leave it up to the client to implement, it doesn't always get implemented, and that defeats the purpose.
Got it. It seems, I don't know, it almost seems like, why wouldn't everybody be doing contract reviews and, some of the different things that you talked about during your presentation, but why wouldn't companies review these costs in-house? Why aren't they just doing this?
We actually get that question a lot. Well, one reason might be if they have a number of other competing priorities, like, for example, a new systems integration, or if they just absorbed an acquisition and don't have their arms around kind of the first 60, 100 days of that acquisition. Sometimes there are other pressing problems. If somebody's really trying to fix a sales problem and isn't as worried about a cost problem, then maybe what we do relative to that wouldn't be as much of a priority. And then I think the general conception, it goes back to what I said, the C-suites, the C-level executives that see cost reduction as an ongoing process are generally not going to feel that way. I mean, they're going to always see merit in doing something like this. The people who view cost reduction maybe as a lesser priority, they're going to feel like it's not as important and as other initiatives, and therefore may not choose to do it at the time that we engage them.
Emmy, you're muted. Yeah, just unmute.
Sorry about that. Yeah, I just also wanted to add, I mean, Miles was talking a little bit from the company's perspective, but from the private equity firm's perspective, I mean, some PE firms have an absolutely systematic approach to cost reduction. So when a new company comes in, irrespective of what they've done in the past and how good they think they are, as far as cutting costs and saving money is concerned, they'll say, well, we go through our process irrespective. And during that process, the discovery process, they typically do find areas of opportunity. Other firms don't necessarily have that systematic type of approach. And so their approach to value creation is a little different, and they will leave it up to each portfolio management.
So this kind of goes into my next question, but I was, as you were talking, Miles, one of the things I was thinking about is sector specificity. So as you're probably aware, in private equity, there's more and more focus on being, specialization and sector focus. Are there industries where ACC or this kind of cost reduction works better? And, are there any particular categories where you see a lot of savings versus others? I know you talked about airfare and travel in certain areas going up and certain areas going down and fixed costs, but anything else you can, any insights around that is appreciated.
Sure. No, appreciate the question. Generally, manufacturing, heavy industry, heavy distribution is going to have a higher proportion of indirect spend. Because if you think you have a plant, you have a warehouse, you have a front office, then perhaps a financial services, a health insurance company, or a company that doesn't have the manufacturing component. So generally, those, at least half of our clients are either manufacturing or just heavy distribution. One industry that maybe it's not a great fit is something like the tech industry, where there are a lot of assets being purchased, but those are generally strategic hardware assets, and relative to the overall spend, indirect spend in the tech industry is generally pretty low unless they're a large company. And the categories, kind of tie in with whichever industry you're in. Clearly, until recently at least, freight, packaging, facilities, supplies, and services were really high impact categories for manufacturers and service companies. We're starting to see some unique financial services, procurement card solutions, treasury management, things of that nature that are really starting to show up, kind of engagement after engagement, that show a high value. Absent any category where costs are really going up at that time, not to be kind of too curt about it, but there can be large savings potential in almost any category depending on the situation that the client is in at that given time.
Just on that note, a question came in and I figure we should just talk about it now. Curious as to your thoughts on IT related spend within these companies. Do you see large opportunities for savings in this area?
If it's more the common not commodity, but if some of the more common IT related spend, certainly to the extent that telecommunications, broadband, some of the telecom hardware, circuitry, things like that, yes, definitely. Some of the proprietary or custom kind of software solutions we generally shy away from, and quite honestly, it's because we don't have the expertise, but you certainly could direct, whoever's interested into the right solution if that's the case. But if it's some of the more common recurring generic IT related products, absolutely. Those are things that we manage, quite a bit.
Okay. So a lot of times, private equity firms are probably looking at this right when they're getting into an acquisition. Can you talk a little bit about the process of working with the company through an acquisition or even through the divestiture process?
I'll take the due diligence process and you can take the divestiture process. Okay, Miles. So for the due diligence process, I mean, we really love getting involved day one, and we'll jump right into the virtual data room with the client. And typically we'll look around the data room and we don't really see the kind of information that we like to look at in order to do our preliminary analysis for the company. So we have a list which we have a core list, which we'll always typically request, but then we get to really dive deeply into understanding the business and operations of the company that they're trying to buy and determine what some specific requirements that we have that we might want to look at. And so, of course, that includes the trailing 12-month spend file, but we'll also look at contracts and other nuances in their vendor relationships. So we actually do a deep dive with the company, which is much deeper and more intensive than what we would do in the typical preliminary savings analysis. And then with the savings, the PE firm, of course, will take that into account when they're doing their pro forma EBITDA valuation and coming up with their bid price. Over to you, Miles.
Amy, that answer was so good, I forgot where I was. What was the first question?
You were going to talk about the exit and what we do when.
Oh, sure. So we'll actually go into, we'll align with deal teams and go in and take the savings we've already either implemented or in the process of implementing and project it out using all the intensive data that we've developed over the life of an engagement. And then that will factor into the value of the sale. And we've had some pretty, some of the world's best, firms that represent clients in the acquisition stage that will validate and verify that our reporting is sufficient enough to justify the factoring in the multiple on the savings.
Now you're muted, Danielle.
Yeah, sorry about that. Okay, so I have just a few more questions, and thank you. I see people are chatting us some questions, so I'll get to that in just a minute. Can you talk about some of the primary reasons that PE firms encourage their portfolio to pursue cost reduction engagement?
I'm sorry, Danielle, could you repeat that? It broke up a little bit.
Sorry, some of the primary reasons that private equity firms encourage their portfolio companies to pursue cost reduction engagement, and do you find that it's recommended or it's optional? How do most private equity firms that you work with approach that with their portfolio companies?
I think the ones that we work with, it's optional, however, strongly encouraged. And we would actually prefer to go into an environment where we work with one or two portfolio companies initially and use the results on those first couple to then then everybody wants to join. So versus just kind of being forced on the portfolio, we prefer not to be in that environment. And that's generally not the case with our clients. Obviously there's a variety of reasons why a PE firm is going to want to offer cost reduction to its portfolio. Obviously savings being one. As one of them said to us, it's just really good, portfolio company hygiene. Just making sure you're looking at areas where, things may not be optimal because we don't have the resources, and having somebody come in and kind of just make sure everything's kind of polished up from a cost standpoint. It's also a good indicator of kind of consumer behavior, or kind of the behavior of the portfolio companies. I mean, some really embrace this and run with it and then keep adding more categories to it. Some kind of resist it. And sometimes that's telling to a PE sponsor to an extent, but largely I think it all drills down to the enterprise value creation. That's why they would want to do it.
What are the barriers you see, like within the portfolio C-suite or within the PE firm? What are some of the barriers you see?
Well, obviously, if a PE firm is in the middle of, well, they're almost always raising funds, but if they are in the middle of a really big, other projects going on across the PE portfolio, they may not want to introduce another one. In other cases, there are actually large PE firms have staffs, teams of people on, they employ, that are constantly doing this. So from our standpoint, it's probably not a great fit for us either, because they already have teams of people doing it. Amy, I can't think of any other obvious barriers other than just kind of competing priorities.
Yeah, I agree.
Okay, I have a bunch more that I could ask you, but let's open up to some of the questions that have been submitted by the audience. Again, if we do not get to your questions, we will make every effort to answer them after the presentation is over. So this question is coming up not just from accounting firms, but from consultants in general. I'm seeing this in our Q&A. Do you partner with accounting firms or consultants? I'm just kind of summarizing what the questions, a few questions that came in, to offer services to their clients, or some of them already have these trusted relationships.
Yeah, quite a bit. I mean, we certainly will integrate in with a variety of different consultants where this would be a complementary offering to an existing consulting firm's service offering or relationship. So that's pretty common. Accounting firms, we definitely worked with them in the past. Sometimes the accounting firms that have consulting arms are a better fit than maybe going in with the audit team, because that's obviously somewhat of a conflict. But definitely, we definitely have experience working with them, and it's our goal to not only deliver results to their client, but also make them look good in the process.
Okay, next question. What % of cost reduction can realistically be achieved over a 1-year time frame, perhaps a 2-year time frame?
It obviously varies by category. As a general rule, we like to believe we can, when all's said and done, exceed to the 10% minimum barrier, minimum average across all categories. In some categories, we've seen 30, 40%. In some categories, you might see a marginal, 3, 4, or 5%. But when it's all said and done, if we haven't, exceeded kind of the 10 to 15% range, factoring in the puts and takes, then either A, they've been doing a really, really good job and it was just a challenge, or B, for whatever reason, we didn't do our job, which we hopefully don't do that often, but generally we walk away with a satisfied client.
But I would say from a time frame perspective also, that sometimes if we're confronted with contracts that have just been renewed and we need to wait another 6-12 months to renegotiate that contract, that can hold back some of the savings from a timing perspective.
That makes sense. Just on that question, there was a few other questions that came in that I just want to point to now. Do you have a standard cost savings definition? Soft dollars versus hard dollars? Do you typically track soft value for cost avoidance, risk aversion, process improvements, contract terms, and conditions improvement?
We certainly, where we can quantify that, we absolutely will. Oftentimes there are subsets of elements of soft cost reduction that you really can't quantify. For instance, if the internal employee stakeholders, say they want a different brand of a product they're buying that'll last longer. It might actually be a higher price than what they're paying today, but they buy less of it because it lasts longer. That's a little harder to quantify, but that's an identified need, and we'll put that in place as part of a solution set. So, but absolutely, where we can quantify inventory reduction, credits due, things that are just missed by the client because they don't have the resources outside of a negotiated rate, we will, if we quantify it, we'll add it to the mix and capture it. but we do feel strongly there are some unquantifiable elements that also are captured in our engagements, but we certainly, it's harder for us to kind of identify and claim those.
So just staying on that thread, this is kind of I'm putting a few questions together here. People costs can be the second or third largest business expense: HR, technology, payroll, workers' comp, employee benefits, 401k, compliance. Do you address that? And with that, I would just ask, because another question came on, do you ever help reducing professional service costs like legal, accounting, tax spend?
Yes, so definitely on, so in the HR area, any like temporary staffing expenses, we definitely, that's one of our strong, actually in this environment, that's one of our stronger performing categories. Workers' comp and commercial insurance is definitely another one that we have a lot of experience with. Payroll processing, again, I'm kind of taking the HR angle. We don't necessarily we don't get into health insurance. That's just not, that's too specialized, and it's just always seems to be inflationary. So that's one area around kind of the HR and admin side that we don't get involved in. As far as, kind of, and I'm sorry, Danielle, what was the second part of your question?
Professional services like
Yes.
legal, tax, accounting spend.
We actually have a recent addition that addresses the legal expenses side. We haven't widely used in the past, but that's a new service offering that we've brought into the mix in recent months. To the extent that we can capture erroneous banking overcharges, as I mentioned, that's professional services, your banking. However, we're not going to get involved in obviously the key, negotiables as far as a banking relationship, but definitely can find where there's overcharges. So those are a couple of examples of areas in professional services that we do.
So again, I'm lumping a few questions together because some came in about the pandemic. So does your model address tax credits from the CARES Act? Do you look at that? And then sort of related, a little bit separate, have you looked at maybe real estate categories or anything like that related to resizing in the COVID environment? So just changes there, anything related to the pandemic that you can offer insights on here?
Yeah, definitely we actually have a new tax credit offering. That's, I think, I don't know if it's directly attributable to the CARES Act, but it covers other areas of it's a tax recovery strategy that we employ. We recently beefed up our team of experts on that. As far as the other areas, I mean, it's relating to the pandemic. The real estate, that's not an area we get involved in, kind of optimizing and right-sizing leases. We've been asked about that in the past, and just candidly, that's not an area we've chosen to try to look into. What we'll do if we keep getting, if a client asks us to keep looking into categories that we don't do, our first default is to kind of find somebody, a qualified firm that we either are aware of or we find for them that can serve their needs. We also, though, once it gets to a point where we'll then align a partnership ourselves and offer it out to our clients. Real estate's one that we've never quite aligned with an expert, but we are familiar with other experts, and I'd be happy to kind of forward that information to whomever asked the question.
But very COVID related. So this was a while ago already. One of our clients, a financial services firm, middle market, wanted to reopen their offices, and they were very hard pressed. They didn't know where to turn for PPE. So once again, this was pretty early on when PPE was extremely scarce, and companies were trying to figure out what are the requirements to open up my office safely. And so up from that sprung a whole new business for ACC, which we really didn't address today, which is the supplying of PPE. So we started supplying our clients, and have some US-based, very, very reputable vendors for things like gloves and hand sanitizers and masks, of course, and plexiglass, shields, and and all that sort of stuff. So
No, that's true. We really didn't have a line of PPE products, a year ago, and
we didn't sell any
and a
physical
lot of our
items.
But a lot of our supplier relationships, kind of had that in their mix, and we were able to patch together some high quality groups. So that actually is an example of something that the more that we did, to respond to the pandemic versus some of the other examples that you mentioned, Danielle.
So just sort of staying on this pandemic topic for just a minute, it's a little bit of a interesting question. Many businesses have pivoted to communicating via Zoom and other online platforms. Are there any ways to save costs there? And just in general, are there any new ideas regarding cost reduction and cost management today?
As far as new ideas, I think one of the ones that, as far as cost management, I alluded to it, is really kind of tracking your vendor performance, particularly in an environment where you're working remotely. Because the accountability for managing contracts, accountability for, making sure the scope of work from a vendor is being, delivered effectively, making sure the bills are being paid on time to the vendors. Sometimes we're finding that's kind of a little harder for companies to manage remotely. Just kind of by osmosis, when teams are together, they've fallen into a pattern of having team meetings about topics like that, to address topics like that, or processes like that. So that's an area that the pandemic's really kind of, I think, surprised some people in a challenging way. As it relates to kind of best practices in the pandemic, we certainly think that the tried and true process of analyzing the last your past 12 months spend, looking at multiple vendor possibilities, constantly, kind of engaging and challenging yourselves. And what do we need better from our vendors and we're not getting? Really a coordinated effort to continually, negotiate and track and implement ideas, as well as lower prices that are out there in the marketplace. If you're in an area where prices are going up right now due to the pandemics, negotiate kind of an index versus just accept the price increase. And, we have a team of packaging experts, very, very, very smart people from that industry that know the indices, know where the raw material costs are going up. We'll track price changes to an index versus just, like I said, accepting the price increase that comes across the invoice.
This question may actually be dependent on the PE firm, but how much visibility does a private equity firm have into the cost reduction project for their portfolio company? So you're doing, I assume it's, you're doing work at the Portco, and the private equity firm wants to understand your process and what value you're bringing.
I would say that it definitely is dependent upon what the private equity firm wants and the openness of their portfolio companies to have them involved with our process. But every 2 weeks, we come up with a summary of where we are, what we've done, what's next on the docket. And with the company's approval, we will always share that with the private equity firm to keep them in the loop. And for some private equity firms, that's sufficient. And for others, we actually have a sit-down dialogue and go through where we are in the process, especially if we're working on multiple companies at the same time. Miles, anything to add?
No, I think that's it.
So just following that thread a little bit, a question came: how do private equity firms typically calculate the value of the savings? Understanding that valuation multiples differ by industry and other factors, is there a rule of thumb for what multiple can be applied to the savings?
I think the savings are really reflected in the actual new EBITDA post savings, or even pro forma EBITDA. And of course, multiples do differ by industry. So it wouldn't change the multiple that they use on times the EBITDA. It would just change the EBITDA number higher, of course.
Yeah, right.
Danielle, I was going to go back to a past question I just saw on the screen. The person asked about kind of the real estate categories. So there is a broad, and this is something we do, there is a broad category called, facilities maintenance. And that is different, many categories, waste removal, cleaning, pest control. It also includes PPE. We definitely, have seen an uptick in interest in the total full facilities management solution for either commercial real estate firms or their properties. And oftentimes these are tech enabled. So you can come in and order and then fulfill that order online. You don't have to be on site. And so that is an area, now that I understand the question a little better, that is an area that we actually are seeing quite a bit of activity in today.
Great. So I am putting a few questions together here. Your approach, do you apply a systematic process across a portfolio, or do you go company by company to lower the expenses? And with that, I would just add, do you and your staff do the audit and negotiation, or do you outsource?
We audit it ourselves. It's our team. We do a hybrid approach. We feel that total customization for each portfolio company across a portfolio is not the most efficient way. However, a one-size-fits-all approach doesn't really work very well either. And so where the categories where a systematic approach works the best, maybe something like office supplies or maintenance supplies that are very common, we may recommend that direction for the PE portfolio. Some areas though that are more customized, maybe like specialty packaging, commercial insurance, even telecommunications, we'll actually look at the individual needs of that company and work with them only, not as part of a portfolio-wide effort.
Okay, I think we're getting to the end of the questions here. I had another one about due diligence. If there's any specific areas that you identify fat or excess costs right from the beginning, pre-acquisition. Any thoughts there that we didn't cover already?
So, we'll go in and we'll look at, we'll do an assessment of kind of vendor risk assessment as part of due diligence. We'll identify to the extent we can, if a prospective acquisition candidate is dealing with vendors that are either, for whatever reason, maybe don't have a lot of staying power, don't have a lot of buying power, maybe are having financial troubles, we'll flag that and tell them, look, we think that the client has supply chain risks in the following areas. So in the diligence process, we'll tell them what we think the savings potential is, and we'll identify to the extent we can, based on the data we have in the data room, where the risks are. So yes, that certainly, is part of it. But in the end, you don't really know until you dig in and really kind of peel back a couple of layers from that. But that is generally something you can find in the data room, because a lot of supplier contracts are in the data room, and that's where you can start to kind of identify those issues.
Great. Are you ever in a position where you bring in specialized resources in a particular category from outside to augment your offering?
Yeah, absolutely. But we vet them pretty seriously and thoroughly, because obviously that reflects value to our client and us. But the ones that are kind of willing to go through the vetting process and pass that vetting process on our end, we would do that quite frequently. And honestly, part of the vetting process is, are they interested in a two-way? Or are they interested in bringing us into their clients and us, and working both ways? But we don't always tie those two together. We look starting with what our clients need most. If we don't have something already, we'll definitely work with the right third-party firms to see if we can offer it.
All right, that's great. Do you guys have any other parting thoughts that you would like to share? I think we're coming up to the end here.
Well, I'll tell you, we do this quite a bit. These are some really good questions. I appreciate the time and attention that the audience gave us and the opportunity. And we have our contact information available if anyone wants to reach out to us to either kind of clarify something we've talked about, or if you know of a portfolio company or another company that might be interested in our services, we certainly are available to talk, or if you're a service provider and feel like you might have something to offer our clients. We want to keep the door open for follow-up discussion. And again, just thank everybody for the opportunity to present.
And if you feel that your question wasn't answered, we will go through the questions and respond via email as appropriate.
Yeah, I did morph some questions together because they were similar enough, but you may have some that people want some more specificity on. Well, with that, I thank you all for joining us today. Miles, Emmy, I really appreciate you guys sharing your insights today. It was great hearing what can be done out there. So thank you to you guys and Alliance Cost Containment. We will get back to you on some of the questions, and we appreciate everybody's time. I hope you found this valuable. Have a great day, everyone.
Our pleasure. Thank you.
Thank you.
Bye.
Bye.